Hello everyone, my name's Steve, and welcome to my new YouTube channel, Valuing Stocks, where we will do none other than value stocks. Well, actually, but nevertheless, let's get started with the first stock pick of mine. This is actually one that I invested in a little while ago, I think towards the beginning of the year, when Camping World Holdings was about $11 and change. It had fallen quite quickly from the $18 to $20 range late last year, kind of with the plunge in December, well, November, December of last year, 2018. It was hit pretty hard and almost got cut in half. There was some insider buying, and speaking of insiders, this company was founded and is managed. The CEO is a somewhat famous individual. If you watch CNBC's show called The Profit with Marcus Lemonis, so you may know him from that TV show where he invests his own money into struggling businesses, and he does it to save jobs, right, and to make money. But Marcus Lemonis, he founded Camping World Holdings, I don't know how many years ago, but quite a while ago, and has grown this RV dealership. I haven't mentioned yet, but it is an RV dealership, so it's in the business of buying RVs directly from manufacturers like Thor, and then selling them retail to all of us out there in the retail world. And they also acquired a sporting goods store not too long ago, and so are moving in that direction as well, which personally I think is not the best decision, and perhaps the market has reflected that by punishing the stock quite a bit since then. But nevertheless, I have faith in Marcus Lemonis' ability to grow this company and take over the RV retailing world, which he seems to be doing. I mean, the problem is, the market is only so big, but it is still a big market, and they are probably the premier #1 player in the RV dealership space, at least in the United States. So I thought it would be a good company to look at for an investment. So that's what I did in January. I just haven't gotten around to making this video. But I hope to make videos like this as I find opportunities in the market. I have been investing since I was 14 years old. So it's been over 20 years now, so that dates me a bit. And I've learned a lot along the way, and I hope through these informative, well, I guess if you think they're informative, videos, that I can teach you guys who are watching my channel a little bit about investing, hopefully make you a better investor. I say this often to people, but I do think investing is the ultimate side hustle, especially if you can get into some strategies that require less capital. So for those who have $500 or $1,000 to start with, I think it's a perfect thing to do to make some extra money as a side hustle, whether you're a stay-at-home mom or a student, or just looking to make some extra money on the side. This isn't something that takes a huge amount of time, doesn't take a huge amount of capital, right? If you were starting some business or something, you'd be investing a lot of time and money to get it off the ground, and you'd likely see losses for the first couple of years. But investing is something that you can start seeing results right away. So before I bore you all to death, let me get started, because I think my screen hasn't moved, and so this probably doesn't even look like a video. But so let's just get started with this valuation. So I kind of gave some background on the company. The story, I think every stock that you invest in, you've got to know the narrative. You've got to know the story. Without a story, even if it's a cheap-looking stock, if it doesn't have a good enough story, it's not going to get any traction. Just like anything else in life, stories sell. And the same is true in the stock market, I have come to learn. So you want to make sure there's somewhat of a story there to back up the direction that you want the stock to go. So the story here is that Camping World Holding, I'll just call it Camping World, they're in the process of, and have been for the last several years, acquiring mom and pop RV dealerships. So just to give you some background, this market is highly fragmented. And so they have taken a strategy of acquiring some of these mom and pop businesses. You know, let's say Bob and Jane want to retire, sell their business, and don't want to run their local dealership any longer. Well, Camping World can help with that. They'll come in and buy it, usually on the cheap, right? Because there's not a whole lot of buyers out there who could buy your dealership. And they'll buy it from you, and then you can go retire, and they'll continue to run the business, and they got it at a good price, right? So that's the model. Pretty plain and simple, and I think the simpler the story, the better, right? If it's a simple story, then you can understand it and understand how they're making money. So also a kind of a tailwind is in the last few years, the RV lifestyle has grown in popularity. And actually, I'm going to show you a graphic here. Let me. Okay, I think we're back online recording. So I pulled up this graphic. Just had to switch screens here. So this was in a Seeking Alpha article. So someone pulled these numbers and this graphic here. But you can see that since 2003 up till 2017, you can see the growth in RV shipments. But you can see, you know, down in 2003, there were 320, and I believe these are in thousands. Right, so yeah, these are in thousands. So 320,000 back in 2003 RVs shipped, and the total RV retail value is the last column there, right? It's 12 billion in value. But it actually started shrinking, the market started shrinking in 2006 and all the way through 2009, which, as you remember, is the kind of the peak of the, or the trough, I should say, of the financial crisis, and then started building back up from there. So it took quite a big hit, got cut in half pretty much, and then kind of regained back to 2003 levels a decade later in 2013, and then from there has grown quite substantially, and you can see the percentage change from year over year. And in 2017, it grew a whopping 17%, right? So big jump there. So you see in the last few years, it's been quite a tear, the RV industry. And I think it's just kind of the lifestyle, people like that, you know, travel around the country, glamping type lifestyle has become popular. And what Camping World has said is that they're cheaper trailer type campers, not so much the full-on RV, but the trailer type campers are more in demand, at least right now, and that's what they've been trying to steer their business toward. And so it's lower cost, but maybe higher frequency of turnover. So let's go back to the valuation. All right, so I'm back at the valuation here. The base here, so this last year, Camping World had revenues of 4.285 billion, okay? And their operating margins were about 7.58%. Tax rate was about 40%. their reinvestment, so net reinvestment, this means above and beyond depreciation, amortization, which is a non-cash charge, right? So that means really the company's not outlaying cash for depreciation and amortization, but that's a non-cash expense. But beyond that, so beyond just wear and tear on their assets, they invested $904 million, right, which was quite substantial. I believe that includes acquisitions and whatnot. But actually, I don't put too much stock in the base year reinvestment numbers. Those could be a little bit messed up. But what's important to see is actually years 1 through 5, 6 through 10, after 10. So you can see I've got revenues growing, about almost 7% over the next 5 years, and then kind of slowing to 2.6% over the next 2 years, or 5 years after that, and then 3%. 3% is the rate of approximately the rate of the 10-year Treasury right now. So it's kind of reasonable to assume that that's the growth rate of the economy, at least projected over the next 10 years, right? And so we're saying kind of after year 10, it's growing at the rate of the economy, which ironically is faster than its 2.6%. But so essentially they'll grow 5 years. If we assume they grow 5 years and then kind of basically stop growing and it's just inflationary growth, that's what we have baked into this valuation. Tax rate, it was high in the base year, but those can be some one-time things. Going forward, 24%. That seems like a reasonable number. 21% corporate tax rate now in the United States with those recent tax changes, which is good for business. And then I put in 3%. You've always got state and local taxes in there. So 24% is probably reasonable, maybe 25%. Net reinvestment, this is, like I said, what you have to put back into the business beyond just your depreciation, right? The wear and tear on the business. So you obviously have to replace things that wear out. But beyond that, to grow a business, you typically have to, unless you're some magical business, you have to put money back into the business to grow it. And so we're saying you would be putting in $88 million in each year for the next 5 years. Or that reinvestment rate there is 30%-ish. So we're saying you're basically reinvesting 30% of operating income back into the business. And then 6 through 10, that goes down a little bit, right? If you're growing slower growth requires less reinvestment, so it drops a little bit to $70 million. After year 10, maybe $100 million. So let's just say they're putting in anywhere from $70 to $100 million a year into this business, right? So they're doing something. That's some real money. It's being pumped into this business to help it continue to grow a bit. So we're factoring that cost in there. Return on capital has been pretty good. 21% this base year, in the base year. I think it will stay roughly around there, as you can see in these numbers, right? Cost of capital, what I'm assuming is a 10% cost of capital for the next 5 years, and then kind of lowering that cost of capital. Generally, as businesses mature, you can justify a lower cost of capital. This means how much it costs them to raise capital, essentially, right? So if they wanted to go and raise $100 million to do something, they would need to be providing a return of approximately 8%. And that's a blended rate, just to help you understand this, of funding that $100 million through raising equity, dollars from equity, selling an equity stake in the company, right? So issuing shares, perhaps, and so it's blended with maybe doing some of that and issuing some debt, right? And so that blended rate is what we call the weighted average cost of capital. So maybe they, of that 100 million, they raised 50 million from debt holders at a 6%, 7% interest rate, and then they raise the other 50 million from equity holders. Maybe those equity holders would demand a 12% rate of return. That blended rate maybe lands around 8% or whatnot. I'm sure the math in my example doesn't quite work out, but you get the picture. It's a blended rate cost of what they would need to raise capital, right? And so as a company, you want to make sure your return on capital is greater than your cost of capital. If it's not, then something's horribly wrong, and you should not be raising capital at your cost of capital if you're not going to be able to make a return at least equal to or greater than that cost of capital, right? Looks like, though, they've had no problem in making a good return on their capital over the years, and if that continues, that's good. It builds shareholder wealth. So this is a picture of how we think revenues will grow over time. You can see that in that first column. So getting to almost 7 billion in the terminal year, which is roughly 11 years from now. And then you can see how the EBIT, which is the earnings before interest and taxes, how that grows. EBIT times 1 minus the tax rate. So this is basically after tax EBIT in that column. So factoring in taxes, you know, at the end we can expect $360-ish million after tax, right? That the company generates. And this is how much the company generates total. Remember, if it has a debt load, we'll talk about it in a second, it still has to pay those debt holders from that $360-ish million. Net reinvestment, we talked about that. That's how much they have to reinvest every year, right? So I totaled this amount. So over the next 10 years or so, they're going to have to spend $861 million. That's this number down here to reinvest into the business. But free cash flow, which is basically after tax EBIT minus the reinvestment, is your free cash flow. That's what's left. That's free and clear for shareholders to take out of the business. Sorry, my throat's dry. And so they can take this money free and clear out of the business without affecting the operation of the business, right? Because you already accounted for what you need to reinvest back into the business. So you can generate $2.6 billion of free cash flow over the next 10 years, which is a lot more than you reinvested. Terminal value, right? So we're gonna do some math, and you divide your terminal cash flow, free cash flow, by your discount rate minus your growth rate, blah, blah, blah. So that we can explain that in another video. But so you do all this math, and what you get is you got to discount that back to present value. So the present value of your terminal value, it means like the residual value of the business after 10 years is $2.4 billion. You add up your cash flows, discounted these cash flows, but discounted back to the present over 10 years. And you get, that comes out to another $1.4 billion. So value of your operating assets is those two numbers combined. So you're saying the value of this business, so I'm just calling the operating assets as the entire business functioning as a whole, $3.8 billion, right? But Camping World has about $2 billion of debt. Now that's quite a bit of debt, but I believe, if my memory serves me right, about $1 billion of that is not super scary debt, because it's just debt that backs, they use to buy some of the inventory, right? This inventory is expensive, and there's loans, short-term loans, kind of, where they use it to finance the purchase of these RVs and trailers from manufacturers like Thor, and then sell them on their lots, right? and so they finance a lot of that. So, but nevertheless, there's $2 billion in debt. They owe people $2 billion. They do have some cash in the bank, so you net that out as well. That's a benefit. So in the end, what you're left with, after you subtract out, how much you owe people, your equity, the shareholders' equity in this business, I think is worth about 1.97 billion, so almost 2 billion, right? And they've got 88 million shares, almost 89. So that, you take the 2 billion divided by the 89 million, and you get roughly $22.29 per share estimated value, right? Stock was trading at $14 and change today, January 30th. And so the potential upside, I think, is still almost 60% from here if it were to go back up to fair value. And just think about it, that Camping World was almost at fair value, or was around that $22 range not too long, like just a few months ago. So it's not crazy to think it could get back there. And I think that the market is kind of down and out on the RV business. It's not just Camping World, Thor, Winnebago, kind of anything in the RV space. I think part of that has to do with interest rates, right? I pointed that out here is kind of part of this. This is the negative part of the story. Will interest rates hurt the business? Potentially, right? It just makes things more expensive to finance, so I could see that hurting the business, but it hasn't gone up too much where I think people are going to, maybe a small percentage won't buy, but I think still some people who have always wanted an RV will continue to buy an RV. Then also there's another threat, that being the RV, there are some RV rental services, right? Kind of like an Airbnb for RVs. And I could see if that takes off, maybe you need less RVs kind of worldwide, and maybe that hurts the business. But I think that could be a ways off. We like owning things still somewhat. So that's my valuation. I know this video is getting long, but that's what I think. I think you can buy this stock, and you hold it for a while, maybe a year or so or two, and you could potentially make 60%. But do know that there's a lot that can go wrong, right? Whenever you got a company with a big debt load, if you do have a recession and they're not able to sell and they start losing money, if they can't make their debt payments, then you're toast, right? And so there's always that possibility that things happen just right and they're toast because they've got too much debt. That's the danger of debt, and we'll get into that in another video, and how bankruptcy works and all that. But for now, hope you enjoyed this video. If you did, put a like on it and subscribe. I will try and improve the format of these videos so they're a little bit more entertaining and maybe a bit shorter. Feel free to comment below what you think about the video, what you think about the stock. If there's any other stocks you'd like me to analyze, I'd be happy to do so. Any tips you have for me, appreciate it. Thank you, and I'll see you again soon.